Good morning, everybody. Welcome to the Flow Show. Here we are, back. Holidays all done and dusted. Bank holidays, school holidays. Back to getting up at stupid o'clock. Getting the kids up first thing in the morning. Looking forward to that for the next 6 weeks, or however long it is. But such is life. Morning, Kate. How you doing?
Morning, Ryan. Yep, all good. Thank you. Hope everybody had a nice break for those who had one over the Easter weekend. And we are back ready to rock and roll.
Yep, we sure are. And rock and roll is what we'll do. Going to kick off in China. I was on the calendar and then I went off it. China left their LPR rates unchanged in the end last week. Were no real expectations there, but we're on the lookout in case they do start cutting rates. However, some small regional banks have started cutting deposit rates just to, according to the piece, just to protect their profit margins. They're facing a bit of pressure on those. So if that sort of spreads, then we could get another round of widespread easing. But just to bring that to your attention, that was according to the Security Times or press over there in China. Over in Japan, we had some CPI data out last week, which showed some healthy numbers coming in there. These are the national numbers. It's 3.6% for the headline, which is only a pip down on last month, 3.7%, but still sailing above the magic 2% mark. The national core number as well also went up 2 points as expected to 3.2%. They've got their other core measure, the ex-fresh food and energy, that also rose to 2.9% from 2.6% previously. We've had the Bank of Japan's their own core measure of CPI coming out as well. As you can see there, coming in unchanged at 2.2%, was expected to jump to 2.4%. So they want to see inflation stably at that 2% level, and they're building on that. I don't think it makes any changes for what's coming up at their next meeting, which is the beginning of May. But if those numbers keep ticking along, it may put the next meeting after that in the frame. Japan's Akazawa economy minister, he's been the one who's been leading negotiations with US counterparts over the tariff stuff, said last week, we're not going to make a quick deal. It's difficult to say how long it will take to bridge the gap. Other reporters have been putting out stories saying that Japanese negotiators have been complaining that the problem with negotiations is really what's hindering those negotiations. They're saying that the US keeps changing what it wants at these negotiations and is not being very clear on actually what it wants Japan to do. Some other sources were saying that Japan has asked, what do you want us to do? And they can't come up with an answer. So that's a bit worrying. Finance Minister Kato is planning a meeting with US Treasury Secretary Bessent to discuss Forex issues, and will share concerns over tariffs at the G20 meetings. Those are happening this week, 23rd through to the 25th of April. We've got the central bank and finance ministers meeting this week, so further talks possible there. Kate, just going back to the data, CPI ticking along, not being very volatile at the moment, but it's still at the right levels. How long does it need to be stable for at 2%?
That's a very good question, and I think I'm going to be very Japanese in replying to that. We need to be seeing it stable, and stable in Japan is much longer than everywhere else. So I think, on the face of it, it's good enough. I think we still have to think that all else apart, of course, and we can't take it away, all those negotiations and tariffs and stuff, but all else equal, they will probably at some stage get up to 1%. And there we will see. Now, is it this meeting? That'll all depend on how those debates go surrounding tariffs and the yen level, or the moves in yen, or the stability of the yen. But no, I mean, if we only look at inflation and the growth of late, I think there's little in the way of doing another little leg. But will they do it now? I've heard both sides of it, and so the Bank of Japan is probably not knowing it themselves right now, what they are going to do in what is it, a week and a half's time or so. It's on the, what is it, the 1st of
Yeah,
May. Yeah,
beginning of
so
May. Yeah,
a week and a
next
half's
week,
time.
I think.
So
Yeah,
they probably don't know yet either.
yeah, I think so. Absolutely, but yeah, it's one of those. How long is a piece of string regarding how long inflation needs to be above 2%? But I'm sure it'll become clear at some point. Right, from the Bank of Japan to the Bank of England, BOE Green says the risk is that there could be a shakeout in labour market. Says exchange rates, talking about tariffs and US policy and whatnot, says exchange rates haven't gone as theory suggests. To be honest, I don't know what their theory is
Yeah,
on
exactly.
currencies.
What was it?
Exactly. Says it's too early to say where the dust settles on currencies. So obviously talking about the recent moves. Says UK wage growth remains pretty high and services points to further inflation persistence. And she's more worried about service inflation than wages. Says the rise in inflation expectations are also worrisome. And she's put in her neutral rate at 2.25 to 3.5%, saying that's not unreasonable. ECB's Ren says inflation is stabilising at the 2% target. Another one joining Vilroy in the victory laps. Says tariffs have conflicting impacts on inflation, and sees the total tariff impact on the euro area inflation as modest, but does see some short-term downside tariff impact on European inflation. Just before the show started, Handelsblatt came out with their usual update saying that the German government is going to be forecasting stagnation in 2025. That means we're going to be getting their latest German economic forecasts, and Handelsblatt usually have the scoop on those a couple of days before. So they're predicting that growth is going to be pretty much flat lining this year, which is not too far from what they've already been predicting. But just in case you see that headline in the next day or two. Fed's Goolsbeast says we've got short-run inflation expectations up, but long-run expectations not rising is very important. So talking about how the market is getting all short-term bullish on inflation, but those longer-term inflation expectations are not rising in line with those. And that's when the Fed will really take notice if we see those picking up. Mr. Trump says there's a good chance of a Russia-Ukraine deal this week. He's also slapping the Fed again, and it's becoming a bit of a theme. Also picked up in the Wall Street Journal. Trump has said that he's warning them maybe an economic slowdown unless the Fed cut rates. So he is seemingly putting the ball in Powell's court as to if anything goes wrong with the economy, or the blame game, shall we say. Now, this was crossing some of the headlines, but the numbers aren't exactly inflammatory. Trump's approval rating has apparently dropped to 42%, the lowest since he came to the White House. The prior was 43%, but when he took over, it was only at 47% anyway, so it hasn't shifted a huge amount. But within this Reuters Ipsos survey, 57% oppose the presidential freeze on university funding over policy disagreements. Why that's important, I don't know. And 74% of Americans have rejected the idea of Trump looking for a third term, which is something he's touted as well. So things are souring a little bit on the poll front for him there. Been a bit of a quiet one, really. Kay, you got any other bits and bobs that have popped up over the weekend?
Well, we've seen the first demonstrations and people taking to the streets over the weekend as well. There's this little U.S. setting like 3,500% tariffs on solar panels. That's from Southeast Asia. I mean, even if negotiations are still going, those things are still putting pressure on countries like Vietnam and everything. May have had a little bit of an impact, and then. Well, apart from that, the blame game between Trump and Powell, it is still very unclear whether he could get rid of Powell before his term ends. There's two different two different expiries there, I will say, or dates there. One is May when his mandate as Fed chair, leader of the FOMC will expire, and then 2028, where because he's still one of the Fed governors, right? So it could get to the Supreme Court. And that is now something that I guess the market will keep a very close eye on now as well, because we saw the impact when he started to really try to even get rid of him, right? I mean, or at least pressure him a lot. The market didn't like it at all, and so that is going to be now one of the stories that is going to be followed very, very closely. For the rest, no. Well, it's just still lingering under the surface, perhaps, but not too deep. Europe and other countries still approaching each other. Von der Leyen was out with saying that quite a few countries are approaching the EU now. This is part of what we're seeing as well in markets where, as we were saying already, and I was saying already, I mean, if the biggest block is uncertain enough, you jump onto the next big one. So that is now also part of why the euro is enjoying compared to other countries, other currencies, more inflows as well. But I mean, it's still part and parcel of the whole big tariff trade global balance picture, right?
Yeah, which I find strange because Europe is one of the worst for tariffing everybody. And that flies, I mentioned it, I think last week, that flies under the radar quite a bit. I mean, if Europe wasn't hitting US goods with so many tariffs, they probably wouldn't be in the mess they are with Trump. But everyone seems to think Europe is the free open market of the globe now. And
No, I don't.
from
Well, I don't think it is really that. I think it's rules stability more than anything else. And well, Europe is ready to make deals, whatever it is, whether it is with some VAT or quotas, but they are because that, for instance, they did it with Australia. It seems that UK and Europe are on a slow but steady rapprochement, as they say in French, and I forgot the English word for it. But then also Europe is in talks with that Mercosur organization, South America. China is knocking very hard on the door. I think it's rather a case of when you sell in Europe, once you have your deal, you have a deal, and it's not so much volatile the deals than on the other side of the Atlantic, and I think that's where we are at now, and that's without going into whether it's right or wrong, or the purpose of everything is right or wrong, we see the impact of it. I have my own idea about that. But I mean, it's the volatility of decision making and the harshness and the bulldozer style that have been applied by today's U.S. administration and the U.S. president that are sending U.S. trade partners into each other's arms instead of them first of all discussing with the U.S. And that is where we're at now, and where the markets are at as well, and why we have this impact, and why you have such actually big flows into Europe. But let's also not forget that Europe is working together on their defense and everything. Um, Germany cracking open the eggshell for the spending as well. All of that is driving investments from into Europe, but also just because it's the second biggest bloc.
Yeah, very much so, mate. I agree with all of that. And just to go on to what Ali's saying, if you're talking about intervention in terms of official intervention by central banks and whatnot, we're not at that point yet. As many central banks have pointed out, yes, we've got volatility, but we've not got financial instability. And while that's the case, they're not going to intervene in markets in volatile moves. If you're talking about in terms of government policy, who's going to fold first? Well, this is the game we're in at the moment. Trump's already shown after his tariff thing how he could react to markets, so he is probably keeping one eye on markets and seeing what's happening. And if he gets some big moves again, then negative moves for the US, then he's probably going to offer some concessions and dial it down a bit. So we're still in this game. The end game is still for him to get deals done and whatever. And there's plenty of people queuing up to get deals done. It's just whether they can get them done and whether the US officials actually know what deals they want. If we look back to that Japanese headlines. So, yeah, it's ongoing at the moment. Volatility going to remain until something happens, and then we'll see what markets want to do with it thereafter. Right, just going to have a quick look at what's coming up this week. Not an overly busy week. It is PMI week. So we're going to get those kicking off from sort of Tuesday night, Wednesday morning around in Asia, then through to Wednesday day in Europe, then through to the US. And really we'll get to see the data doesn't really matter at the moment, and it doesn't really matter in terms of central banks because they're all going on into we don't know what's going on mode. But what the data is useful for is, again, seeing if we are getting some impact from tariff stuff. You know, the weeks are ticking by. So we know how some firms are, finding it tough to make decisions, investment decisions regarding their businesses. So we'll have to see if economic activity is being impacted. Once again, though, we are mainly seeing this sort of stuff in the private and sentiment data, not yet in the main headline hard data, as it's called, particularly for the US. So that's what the market's going to be looking at. I think it's ready for the US economy to take a downturn. It's waiting for it. It's chasing that bone. Good data is being brushed under the rug. Anytime we get hard data that's coming in bad, you're probably going to see the market moving because it'll be told you so type moment. But until then, we've got the PMIs coming up. We've got some further housing data from the US, new home sales coming in as well. UK public sector finances, just keep it. I don't know why my clock's all showing that. I haven't set the time for that. That's obviously in some sort of US time zone at the moment, but that's 7 o'clock UK time to see how the old Chancellor's fiscal headroom is going and all that sort of stuff. Then on Thursday, we get the IFO survey. And again, that's going to be another sentiment reflection of how the market sees things post the little boost that we got for the 500 billion investment stuff and see whether it's going to go in reverse like we saw with the zoo last week. Durable goods, jobless claims, existing home sales further on Thursday. Then on Friday, pretty relatively quiet day. We've got UK retail sales that had a bit of a bumper number last month, so we can see if that run continues. Canada retail sales, and then I think that's the final Michigan consumer. Yeah, it will be this time the final Michigan consumer sentiment data. Then, so not an overly busy week on the data front, so we'll be trading everything else that's going on, no doubt. Anything on your calendar this week, Kay?
Well, I think it's interesting now that we are going to see more and more April data, and that is, that is what we are going to now focus for. Up to now, apart from a few, we have had still data from pre-tariff polls also. Now we are getting into those April data, and obviously the market is going to keep a very close eye on what is happening now once the tariffs have been announced.
Yeah, pretty much, mate. Right, well, let's have a look at what's going on in markets. Let's just get that on a bit of a wider screen. Going to have a look at dollar yen, which continues to bleed lower. There's no signs of this stopping anytime soon, it seems. Whether it's what's going on the US side or the dollar side. Oh, keep need to zooming out. We're under this 441, 442 area now. Rallies are getting hit pretty swiftly. We've got this fib coming up down into the low 139s, and then the next big level for me is the 138 area. So this is the same as all your 142s, 145s, 147s, that sort of thing. This 138 down below, so keep an eye on that one if we get there. Kay, your thoughts on this one? Where does it stop, or does it stop? We could have this dollar weakness continuing, and then if we get the Bank of Japan turning a bit more hawkish and things playing ball, this could keep on trucking.
Yeah, and we don't know what's going to happen on the FX side. Although we had a bit of a hint at the end of last week when Akazawa, I think, or was it Kato, saying that fundamentals will direct the yen, and that is something that I spoke about as well, which Japan has been saying for years and years, that it is the market who will decide on the levels, and that they are not purposely weakening the yen. So let's see what comes out of those negotiations. But yes, I mean, dollar is weak, yen, Swiss are strong, and for the time being, it's hard to see a reversal coming, right? I've got a pretty big level at 138.75, and why not test it? This is where we are now, is bang on the 61.8 of the 2023-2025 rally. That's where we are at, right here at 140.5. I would say, though, any correction, let's put it that way, I don't think that we are ready to see reversals right now on the dollar, unless Trump's administration also does a real 180 and says what was all just a dream. Unless we see a complete reversal, we are going to find rallies that are still on the dollar in global, but also obviously on the dollar yen. Unless we then get a surprise on those FX talks, where that could actually mean that rally, that market being too short at too low levels on the dollar yen, and you get back above 141.75, quick rally up to 143.5, 144 is never to be ruled out, of course. But I would say, yeah, right now it's still coming down, and if the dollar is not reversing anytime soon, I think we are at least in for that 138.75, and why not a bit lower if the rest of the dollars continue to weaken. We are in this process of of confidence crisis. You can call it safety right now in all US things. Bond market, US dollar especially. Equity markets are stabilizing. I mean, maybe people have sold out enough right now. It did go down 20% after all. Yeah, and I can't really say much more about it right here and now. I mean, in the very, very long term, give me 100 and I don't know, 128, 130. I'll try probably a longer term long again in the dollar yen, but it might not be the dollar yen. It might be another cross against the yen.
Yeah, absolutely. And this is again, this is one of these situations. I mean, even you look at euro dollar. This is one of these situations where, you know, a few weeks ago we were down at 105, and we've done, you know, over 1,000 pips in just a few weeks, where we spent months and months, you know, in really tight ranges. So that's a reminder that when we talk about flows and investors moving money from US to wherever, it doesn't happen overnight. These things can go on and on and on, and it can drive the price very far with fast moments, as we've seen already. And trying to pick where those stop can be a bit of folly. So you can't ignore a lot of these moves at the moment. Still quite volatile. While I'm on US dollar, this is, let's go to a bit of a wider chart, might make it a bit clearer. This 115, I'm in two minds about this one. We broke this 115. It's a big old level. It's one of my big five, if you like, that we've traded around for the last few years. A huge level. We broke it, but we broke it on a Easter Monday when there's little liquidity going around. So I'm always very skeptical when we get breaks of that nature, big levels, and the sort of holiday trading. So I think it's going to be a measure of whether we can hold up. We're not doing that at the moment. 114.92 trading. So we're back under this level. Now we have washed out whatever's there. If there was barriers and stops and whatever, we've obviously cleaned those out. So the egg's been cracked. Probably just this prior high, as you can see, we've had a few little lows when we've dipped under 115 down towards sort of 80, 85 area. That's your sort of safety net at the moment. If we're breaking back under 80, I would say, then maybe we're going to see 115 coming in a bit more solid again. It's already looking like it's trying to resist up here. If that's the case, then we might see a bit of a steeper pullback, maybe at least down to 114, maybe a bit more. But if we get that sort of move down to, say, 114 and another bounce to 115 and it holds, that's going to look like more of a proper hold than all this messing around we've had on a bank holiday Monday. In that case, I'm not saying everyone needs to pile into shorts on that, but it will maybe cement the level once again. Conversely, if we keep going, there's some big levels above. Yes, mate.
Ryan, go back to your prior the 1 hour chart there, because I think it's interesting in what we've seen. If we just purely think about what Ryan just said and what we've been talking about, you can zoom out just a little bit if you can. Just think about what we've been talking about so often, and because we are not a purely technical show. I mean, we talk about fundamentals a lot. So just like zoom in just slightly, sorry. Look what happened once the tariffs and everything came into play. Yeah, we're talking about their end of March, beginning of April. We had big move higher, then we stabilized because we didn't know exactly what was going to happen. And that was all those Truth Social posts about, yes, but if you behave nicely, we are going to discuss. But then look at what the price action that happened is telling us quite a bit, because then at that point we were talking about what's so that was then beginning of April, let's say. We were talking about what's going to happen in the 109, 108 and a half zone and stuff like that. Well, the flows told us that they were buying, and then we spiked higher. Then we came back to retest it once more around the 10th of April, and then we shot higher again. Then we were talking to you about that 112.2070 afterwards, which also started to which also held. This is just still telling us that, I mean, on every retracement, finding bids like that, it means that the flows are not done. And now I guess we will have to look at what's happened in the, let's assume that we go back to low 114s, for instance. If those start to hold and you trade a couple of days around 114 without it going too much lower again, even without making fresh highs, but if we start to hang around there may be the next step coming, because that means that all those longer term or medium term flows are not done yet. So that it is something that we need to pay attention to, and you can skip all the lines, and I have a lot of lines as well, and try to find patterns and stuff. But you just look at the price action, and you're moving up in steps like we have done right now, even bigger steps. And we told you that it was going to be volatile, so you have to take those into account. But if you start to hold levels where it kept before, and now I'm really thinking about, if I look at it in a very simple way, take 114. Imagine we're going down to 114 because the market wants to take profits, those who are in good positions, and we hold there pretty stubbornly. That may hint to us again that we are not at the end of the flows, right? Now, and most of the time, those big flows, they can be aggressive at the start, but then once they have done a part, they're much more likely to be kind of passive. Think of it as, for instance, I don't know, an importer in dollar yen, or an exporter in the euro dollar, and they have to buy euros at some point. They are not going every day to the market and go like, "What's your offer?" And I'm buying, I'm buying, I'm buying. No, they probably goes like, "Okay, if it goes back down, I'm going to sit on the bid, see how much I get, and then do the next one, and then do the next one." So now we have to look at those levels. We have seen like pretty decent steps, and to know whether the flows are done or not, just look at those prior highs and where we stabilized and then did the next leg higher. That is likely where those bids are going to be parked now. So without wanting to look at all fancy tech levels or extensions or triangles or whatever, just look at those steps, and those can give you a hint at where bids, more than us retail traders or hedge funds even, like, but where the real bids are parked.
Yeah, that's very important, what you've said there, Kay. And it's also taken into account when you get investment flows that are moving. So if someone's changing a book from US assets to European assets, there's a whole shift, an asset shift. But from then on, those firms are going to be telling their customers, we advise investing in Europe. So any future money that comes in to be invested is going to go into Europe. And so you get this big move where everyone's shifting assets. Then you get a bid remaining because further future business is going into those assets still. It's not just, oh, we've shifted from A to B and that's the end of it and there's no more flows. Once you're in these assets, you're going to be telling your customers to get in these assets. So someone turns up with 5 million to invest, stick them in Europe. And then that's more flows that's going through euro into stocks, bonds, wherever they go. So that's where you get, as Kay says, you get these fast moves. That's the big shifts, but then you get it supported longer term by future business going into this stuff. So it's all very interesting. And as Kay says, you can generate that idea from the price action you see in these markets, because euro dollar moving 1,000 pips when we've spent months and months in tight ranges just tells you that something big is going on. These things don't happen often. All right, let's move on. Aussie dollar. Everyone wants to know about Aussie dollar, which is looking very interesting at the moment. Now, if you've been following us here on the Flow Show in our chat room, I've been talking about this 64.40 potentially being more important than the 64 level that we've been banging our head on for several weeks, and here we are, and we're banging against it and can't get through. We're just ticking under the figure now, which might be significant. I think you've got to give it down to these prior lows, 90s, maybe even down a bit further, 85s, 80s. We've got the battle on now. We've had this 64.40. We can't get through. Now we're putting pressure on the 64 level. If we're back under here, 63.90, 63.80, maybe we're going to see us dipping a bit further. But I'm not sure we're going to be dipping, massively low. I can't see us getting back to 63 or something like that unless there's a headline to trigger it. Or unless people really do short-term long start to jump out the window. So I think we've got a bit of a battle going on here, and you've got to take your cues by what happens. I'm actually might have a little nibble in a minute if we do hold around here. Because I think I was looking for a potential buy stop through 64, but I was worried about that 64.40. And several ways I haven't played it at all at the moment, but I might do. But you can either buy on the break at 64 and then look for confirmation of a break through 64.40, add another bit. But I may look to buy a little bit on this dip here, see what happens. But if we keep hitting this a few times without dipping too far, that's going to potentially set up a break. So I may add a little buy stop above there anyway. But in terms of what you do up here, well, as I say, it's pretty tight. 64.40 is your resistance. 64, 63.90 is your support, and really take your cues by whatever side goes on that one. Can you do anything in the Aussie?
Well, I'm small long from the end of last week. No, actually, from the start of this. I mean, I bought the open on Sunday around 3.75, but I've already sold half out because it was an Easter weekend move up to that 64, 35, 40. So I've let half go and then see what happens with the rest. It is still a laggard. I mean, if you look at Aussie Kiwi, for instance, trading at the lows, really lows of what is it? Is that a year low or so? Yeah, start of 2024, right? So that's that. It just shows you that the Aussie is still very much a laggard. I'm not sure whether it's people say China also still being a point of contention, but it's lagging everything. It's even lagging copper. It's lagging gold. It's lagging because Aussie is a commodity currency. It's a strange laggard for me, and that's one of the reasons as well that I actually bought it because. Okay, first of all, the level I thought we were going to test and potentially break, but then secondly as well, I wonder if there's not going to be all of a sudden a surprise catch up on all the rest, and then we will find Aussie in the 65s. That's the kind of the way I'm looking at it, but we have to still, and I have to still also not forget that it is still a laggard and it's going a lot slower than any of the others really. So yeah, thinking we go for a break, yes, but bearing in mind that it is a laggard and goes back below 63.80, I'm probably going to let the rest go and just take the few pips that I made and call it a day, and then watch that 64, 64.40 again, you know?
Yeah, and I think this is a dangerous one because if we do get a turn in the dollar to more bullish, the lack of momentum, upside momentum in this one could mean it goes down very, very fast compared to some of the others. I think that's the risk for this one. You know, you always worry about when you see everything else rallying and a certain pair or asset can't rally even in sympathy. Obviously, it's been a strong move, but if you look at this move off from the 59s, yeah, it's a big old move. But if you look at the euro, it didn't do the down move first before it shot up 700,000-800,000 pips. So yeah, I think as much as I'm bullish on a break of 64 longer term, I wouldn't be saying thinking I'm that bullish longer term if the dollar turns.
No.
What are your thoughts on that, Kay?
Yeah, I mean, you always have to think about exactly what we've been talking about. Why? I mean, I failed to really find a real reason why it is such a laggard. Looking at the commodities, for instance, looking at negotiations that they may have left here and there. Yeah, I know. I mean, the US has been hammering a little bit their beef industry, but how much is that in terms of Australian GDP, right? So I'm struggling to find the real reasons why it's a laggard. And if I don't understand something, I usually keep it smaller as well, because you don't really want to run into something where all of a sudden the real reason springs out. But yeah, just be careful on this one. You can trade it both ways actually if you're planning to trade it. I think Ali is in some as well. You can trade that short and then have it against the 64.40. But if it breaks 64.40, then I think we are going to see 65s pretty rapidly. But yeah, it can fail. It can easily fail here too. So keeping everything in every possibility in mind here.
Yeah, thanks, mate. Right, I'm going to ping it over to you for a few, so you can have a little old look. There you go, mate.
Thank you, Ryan. It's going to be a quick look um, well, everybody is talking about it, gold, gold, gold. I just wanna say that and that was around here when we did our end of year preview ForexAnalytix. I said for me gold is one of the trades of 2025, and it is working. So that's one of the reasons why people, not only because of me or Ryan, but there's a lot of really good traders and people trying to help each other, why you should really join ForexAnalytix. But let's have a quick look. 3509 around here is an extension. It's very hard to stick levels on instruments when they break all-time highs, especially, I mean, it's an extension, yes, but it's just a number, okay? I guess every 100 to 500 bucks, if this continues, is going to be a bit psychological. But if you look at it above here, above 35, 35.10, there's not a lot for another 150 bucks. So if that 35.10 goes, and it may or could likely go during an Asian session, because we have seen again of late, and I've been banging on about it, and I will do it every day. Watch what the Asians are doing, because they are having a lot of the key of what is going on in gold, and it's not only China, it's not only PBOC, it's just all the Asians, all the privateers as well, all the investment money in Asia as well. Asian sessions are still very big for gold. That is still going to be key. They've been quiet for a while. Sometimes, they've been quiet for a while, and then we saw uh, um, sideways actions, or even retracement when they were like big enough through social bombs coming out. But then after the fact, we are still going higher. So, who are we to stand in front of this? Um, Now, it may, as we have seen quite often in the past as well, it's probably not going to go one-way ticket up to 4K or so, which is still possible in my opinion, for as long as the uncertainty goes on. But there's a few levels that we can watch now. Um, Maybe 33.80, 34 as a starter here, and then I'm always look at what the prior high was, and that's the 33.55, 60 area. If it goes below here, then we may have bigger retracements. But if and for as long as I was going to say we stay above, I mean, to me, there's no reason. If even if we do those 100 bucks down, unless something changes in the global situation, what's the reason for it to counter trade? I've seen so many people trying to counter trade it, and counter trade it from much lower levels already. You just get burned. I mean, it's to me, this move is so somewhere logic with everything that's going on. And I've been saying that gold is just a safe haven for everything that can go wrong. And then I've said when the Chinese came out a couple of weeks ago saying that they asked um, their money handlers or money managers in China not to go and buy blindly dollar China and to weaken the Chinese yuan. So if you can't buy dollar China, I mean, if you can't buy dollars, what are you going to buy? So that was another reason for me for this to trade higher. So this is again where we are. So the next level is just for me 35 figure 10, 33.80, 34 the figure, and then 33 and a half. If that goes, if we break below 33 and a half, then we have to look back at those prior lows here, 32.90, 32.80. But if you look at the longer term, where can it turn bearish? I think you need to already start to look at levels of 3,200 for it to really start to turn bearish. For as long as we are not below there, it's probably going to remain on this upward path. Yes, it's going fast. Yes, there will be stops. Like for instance, today we've seen it stop at 3,500, and we went already back to 3,440. I mean, but this is something that is going to happen in gold and is going to continue to happen. Of course, there will be a top one day, but where is it? I can't say it. I mean, if anyone else can tell me where the top is in gold, I'm all ears. But just tell me, have a good argument as to why it's going to be the top, okay? And then silver is much less buoyant. It's really underperforming gold, and you also know why. I think it is underperforming gold. Global growth worries, slowdown everywhere, potential slowdown. This is why silver is really underperforming gold, and it still is. So just keep an eye on 33, 33 and a quarter. If that would go, then I think we are going to do our next leg higher. For the rest, I think we are just going to mooch around here unless something dramatic happens with the US yields. Like for instance, a shoot higher. Perhaps silver could even come back down because a lower bond market is right now meaning that it is still lack of confidence. Okay, so and lack of confidence will likely translate in slightly lower silver for those trading this one. Okay, for silver to really outperform, I think the worst should be over for the tariffs and market looking up. Then I think silver is really going to catch up on gold, and we could actually see a scissor effect between gold and silver at that time. Are we there yet? I don't think so. But as you know, every day can be the top of the gold silver ratio. Oils are very interesting. We broke it above 62 again and seemingly holding. But 63 and a half, I told you 63 and a half for me is a bit of a level here. We are just turning around. Okay, so we need to go and hold that 63 and a half for it to go higher, in my opinion. If we get back below 63, we may be in for a fakie here yet once again and trade lower again. But we are in a very interesting zone, in my opinion, on things oil. Um, Derej, I think, was asking about the Kiwi. We are stopping right in front of a very interesting level, in my opinion. It is the 61.8 of the 2024-2025 dump. And also, it is a level where in the past we saw pretty decent interest. So that's all happening around 60, 35, 40. Keep an eye on that in the Kiwi 60, 35, 40. That's going to be interesting. First support probably lying 59, 80, 70, but then the low 59s are going to be much more important. And I think looking at the time, this is where we should stop really. 15.45 on the dollar Swiss is where we have to look at what is happening, or call it 81 and a half as well on the top side. But if we break and hold below 81, 81.10, this is looking very weak again. Okay, so this is one now on the dollar Swiss. I think we are in a pretty important area for the further moves in the dollar Swiss right now. And with that, Ryan, back over to you, mate.
Cheers, mate. Good stuff as always. Yeah, we'll call it a show for today. Thank you very much for coming here and watching us. Have a good one. Have a good week. Have a good day. We'll catch you all later and see you tomorrow. See you later, all.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.